My name is Toby Fildes, Managing Editor of GlobalCapital, and I'm here to tell you about our forthcoming Euromoney Ecbc Covered Bond Congress, which is taking place in virtual format on our digital platform on September the 9th and 10th. To talk about what's on our agenda, I've been joined by my colleague Bill Thornhill, our esteemed Covered Bonds editor. Bill, based on what we've seen so far in this momentous and challenging year, how do you expect the primary market to evolve in the remaining months of 2020?
Well, we've had a good deal of issuance this year, and then we had the TLTRO3. So we had 68 billion issued so far this year, and the TLTRO3 was introduced by the ECB. We had a huge take up there. There was 1.3 trillion of liquidity taken under that facility. As a result of that, we saw some reductions in the forecast for supply this year by in the region of 20 billion. And for the year as a whole, we expect around 110 billion, which means there's about 40 billion left to come over the course of the rest of this year.
And do you expect the market to remain well supported?
Absolutely. I mean, we've got the biggest thing is CBB3 redemptions. That's the redemptions of the covered bond purchase program, which the ECB will need to fulfill to cover those bonds that are redeeming. There was 1.6 billion in August, 3.5 in September, and 6.7 due in October. So just to keep that portfolio from shrinking, they need to buy that much. Over the whole market, for the remainder of this year, there's 54 billion euros worth of redemptions. So when you calculate the fact that we're going to probably have only about 40 billion of net supply, that means gross supply, that means net supply is going to become negative to the tune of about 20 billion. And that is obviously going to exert a very strong technical influence.
Bill, so you're painting a fairly positive picture for the support for the supply for the rest of the year. But what could derail that? What could change that positive point of view?
There are two factors really. The first one's sort of a macro one, where we're looking at the reinfection wave of the coronavirus potentially coming back in autumn. And that leads to more economic lockdowns and sell-off across the whole equity and credit markets. And obviously covered bonds would not be immune from that sell-off. We would expect a spread widening under those circumstances. It might be that, covered bonds are the safest place to be, that they'll take part in that widening. The second more probable risk is to do with the Bund swap spread. As we know, there's the EU Recovery Fund, which has been put in place, and this is likely to result in much more SSA issuance, as a result of which sovereign spread could well widen. And that's likely to lead to a tightening in the Bund swap spread. The Bund swap spread has been trading in the range of 25 to 55 so far this year, and it's currently towards the low end of that range. If the Bund swap 10-year spread starts to come down below 20, it's going to make covered bonds look really expensive. Covered bonds will have to widen across the board, especially in the core markets. I think that's a real problem for the market.
Bill, what impact do you think the mortgage moratoriums are having that we've seen across Europe following the coronavirus on the covered bond market?
Well, so far the numbers have come in, they've been very divergent. The UK and Italy are reporting the highest numbers. In the case of the UK, that's around 20% of total mortgages, and it's slightly less than that in Italy. And then at the other end of the scale, you've got places like the Netherlands and France, which are reporting numbers in the low single digit area. Now, the coronavirus hit everyone with an equal force, and it's difficult to imagine why such a big divergence should exist over the longer term. So what's likely to happen is the lower numbers will, the numbers will converge over time. ultimately, the big question that not even the issuers really know is how many of these payment holidays will translate to potential delinquencies and then non-payments. I think the key message here for the covered bond community is that, over the course of the summer, over the course of this year, in fact, over collateralization levels have risen quite a lot. In most cases, when you look at the aggregate numbers, and in fact, if you were to strip out all the mortgage moratoriums and net that against the increase in OC that we've seen across a lot of jurisdictions, the impact would be fairly limited. And the other important point is really that the key rating driver for covered bonds is not the collateral pool, but rather the rating of the bank and the rating of the sovereign. So those are going to be the key determinants that shape the outlook for spreads.
Moving on to green or ESG, how do you expect the market to evolve in terms of originating green residential collateral?
Well, up until now, all the green covered bonds, and we've had quite a few, and the numbers are improving, seem to be improving every quarter. But what banks are doing is they're securing these deals with collateral which is secured on new homes. Obviously, new homes have much higher building standards, and the energy efficiency of those homes is significantly better than is the case for older homes. The problem with that is that most people live in older homes, and therefore the big strides that are going to be made in the market are going to be where people refurbish their homes and can show that they've made a big jump in energy efficiency, for insulating new sort of heating systems and so forth. That's where the real big gains are going to be made. But so far, none of that collateral has appeared in any covered bond or RMBS or anywhere, and it needs to happen.
Okay, thanks. And what is the Ecbc doing to promote the production of green residential mortgage loan production?
So at the moment, they've got three flagship projects that they're doing on historic buildings based in Venice, Florence, and Nicosia. And what they're trying to show there is that, you can make big energy savings on these old historic buildings that weren't necessarily designed to save energy in the first place. And with that, they're hoping to show, that there's a big jump to be made on refurbishing property by way of example. The other things that they're doing is they have, under their energy efficient data protocol, they've been gathering data for the past few years on the sort of likelihood of payment default for green mortgages versus normal vanilla mortgages. And this is a study which is being conducted with the University of Venice, Trinity College Dublin, and Goethe University in Frankfurt. So it's pretty high level stuff. But basically, they've got 50 pilot banks involved in it, and ultimately what they're attempting to show is that green mortgages are in fact slightly less risky than vanilla mortgages. People will make a bigger effort to make their payments when they've refurbished or when they put effort into their houses to have an energy efficient mortgage, essentially. This correlation is what they hope to demonstrate with this, is to somehow get a lower risk weighting, a lower capital charge for green mortgages. That will then incentivize banks to pass on the cost saving to their customers and create a virtuous circle whereby more and more customers take out green loans because they're essentially cheaper and they have to hold less capital on their books for these loans to be originated. And then there's another strand, which is that they are on the harmonized transparency template. They're updating that this autumn. And what they're trying to show there is adapting it to show that issuers who have green collateral pools are, what the savings are, what the carbon savings are. And for instance, if you have if you've done a refurbished house, if you've conducted a refurbishment of your house, potentially what the improvement in the energy performance certificates are, and so forth. That hasn't been unveiled yet, so I wait to see what happens. But it's a transparency initiative that is designed to help investors understand more on the underlying mortgages and the energy savings that are happening. They've also applied for a load of funding from the European Commission under the Horizon 2020 project, and with that, they're hoping to basically roll out energy efficient mortgage production or origination to 8 member states within the EU on a much grander scale. So hopefully take it up, it'll be sort of pioneered by the pilot phase banks and then pushed out to the wider market.
Okay, thank you, Bill. And thank you everyone for watching and listening. We very much look forward to welcoming you to our forthcoming Covered Bond Virtual Congress in association with the European Covered Bond Council. The dates are September the 9th and 10th with panels and keynotes timed at various times of the days to encourage participation from Asia and the Americas, as well as Europe, of course. You can register your interest on our website, where you can also see our full agenda. Thank you very much.